For most of human history, trading wasn't something you downloaded. It was something you earned the right to do. In ancient Mesopotamia, traders crossed deserts with caravans, carrying grain, copper, and cloth for months at a time. In Athens, trade happened in public squares, slowly with witnesses. In medieval Europe, merchants waited weeks for ships to arrive, not seconds for candles to form. Information moved at the speed of horses, wind, and rumor. If you traded, you understood one thing very clearly. You could be wrong, and being wrong was expensive. That slowness mattered. It filtered people out. Only those with patience, capital, and tolerance for uncertainty survived. Fast forward to the 1600s. The world's first stock exchange opens in Amsterdam. Shares of the Dutch East India Company are traded in coffee houses. This is revolutionary. For the first time, ordinary citizens can own a piece of global trade. But even then, trading is not frantic. Prices move slowly. Positions are held for years. Losses are accepted as part of business, not as personal failure. Now jump to the late 1800s. The telegraph changes everything. Prices can travel faster than people. Suddenly, timing matters. Speculation grows. Fortunes are made and lost. And for the first time, markets begin punishing emotion more than ignorance. This is when the first trading rules appear, not to make people rich, but to stop them from destroying themselves. By the early 20th century, trading floors are loud, physical, and brutal. You have to show up. You have to shout. You feel losses in your body. Most people never even try. The barrier isn't intelligence, it's pain. Then comes the computer. In the 1980s and 90s, markets go digital. Speed increases. Institutions adapt. They build models, hire mathematicians, and think in probabilities. Trading slowly becomes less about opinion and more about survival. The edge is no longer knowing something others don't. It's managing risk better than others can. And then, quietly, everything breaks. In the 2000s, trading is placed into the hands of the public. Online platforms, zero commissions, leverage on demand, charts that update every second. No gatekeepers, no friction, no waiting. For the first time in history, you can trade global markets while standing in a grocery store line. And that's when the 93% problem begins. Because the modern trader inherits a system built for professionals, but enters it with instincts shaped by a very different world. A world where speed means advantage, where confidence is rewarded, where hesitation looks like weakness. But markets don't work like social media. They don't reward activity. They don't care about participation. They punish urgency. Most new traders think they're joining a skill-based competition. In reality, they're stepping into a probability engine that has been refining itself for centuries. The rules didn't change, only the access did. The math stayed cold. Humans stayed human. The market still demands the same things it always has: patience, humility, and the ability to accept small losses without emotional collapse. But modern trading encourages the opposite: constant stimulation, instant feedback, the illusion that every move matters. It doesn't. Yet traders act like it does. They overtrade, they oversize, they confuse movement with opportunity. When they win, they feel smart. When they lose, they feel targeted. They begin trading not to execute a plan, but to repair their self-image. And that's where the history repeats itself. In every era of trading, from caravans to candlesticks, the same pattern emerges. Those who treat trading as a long-term business survive. Those who treat it as a test of intelligence don't. The difference now is scale. In the past, failure was slow and local. Today, it's fast and global. Accounts don't fade away, they disappear. So when you hear that 93% of traders lose money, it's tempting to think something is broken, that the system is unfair, that the game is rigged. But history suggests something else. The system hasn't changed much at all. It's still designed to transfer money from those who demand certainty to those who accept uncertainty, from those who need to be right to those who can afford to be wrong. The real change is psychological. For the first time in history, millions of people are trading without the one thing every successful trader before them had: respect for time, risk, and silence. Which leaves a final question hanging in the air. If trading has always rewarded patience and punished urgency, why need we build a world that encourages the opposite? And what happens next when even more people press buy without understanding the game they just entered? And there's one more detail history makes very clear, but modern trading tries hard to hide. Every generation believes this time is different. In the 1920s, people said radio stocks could only go up. In the 1990s, it was the internet. In the 2010s, it was crypto. The story always changes. The behavior never does. Each cycle brings a new crowd convinced they've arrived at the moment where old rules no longer apply. But markets have a long memory, longer than any trader. They remember leverage. They remember panic. They remember what happens when too many people confuse access with skill. And they have a very specific way of correcting that confusion. Slow at first, then all at once. This is where the losses accelerate, not because traders suddenly become worse, but because the environment they relied on quietly disappears. Volatility spikes, liquidity dries up, spreads widen. The same strategies that worked yesterday stop working without explanation. And for the first time, many traders realize they were never trading the market, they were trading a mood. When the mood shifts, the market doesn't explain itself, it just moves on. What makes this era different is not that people lose money, that's always been true. It's that loss now happens in isolation, in silence, on personal screens. No trading floor, no shared panic, just a red number and a refresh button. So traders internalize the failure. They assume they're missing something. One more indicator, one more strategy, one more video. But history suggests the opposite. The problem is rarely lack of information, it's excess confidence in short-term certainty. The market has never rewarded certainty, it has always rewarded restraint. That's the part no platform advertises because restraint doesn't generate volume, patience doesn't increase engagement, and silence doesn't sell subscriptions. So the system quietly filters people out the same way it always has, not through intelligence tests, not through morality, but through endurance. Most traders don't fail in a dramatic collapse, they fade out. Smaller position sizes, shorter sessions, longer breaks, until one day they stop opening the app altogether. The 93% isn't a statistic of failure, it's a record of people who entered a centuries-old game believing speed was the edge, activity was progress, and confidence was protection. History tells a colder story. Trading has never been about being right in the moment, it's about staying solvent long enough for probability to do its work, and that has always been rare. The question isn't whether most traders will lose money, they always have. The real question is whether modern markets, built for maximum participation and minimal friction, are creating more traders or simply accelerating the moment they discover what trading has demanded all along. For most of trading history, leverage was rare, expensive, and dangerous, which is exactly why it was controlled. Borrowing money to trade magnifies outcomes. Small moves become meaningful. Normal fluctuations become existential threats. In the past, this power was reserved for institutions and professionals who understood its cost. Today, it's a toggle button. Leverage promises efficiency, more exposure with less capital. It feels like progress, like optimization. But leverage doesn't change probability, it only changes speed. And speed changes psychology. A 1% move against an unleveraged position is noise. A 1% move against a highly leveraged position is panic. Decisions that once had time now demand instant reaction. Stop losses become optional. Margin calls become real. Most traders don't blow up because their idea was terrible. They blow up because the position was too large to survive being wrong. Markets move unpredictably in the short term. That's not a flaw. That's the nature of liquidity. Leverage turns that natural movement into a weapon against impatience. The dangerous part is that leverage works until it doesn't. Early wins feel powerful, efficient, almost validating. Traders begin associating leverage with skill. Risk feels controlled because losses haven't arrived yet. But leverage doesn't announce when the environment changes. It waits. Volatility expands, liquidity thins, spreads widen. Suddenly, exits aren't where you planned. Stops slip. Losses exceed expectations. This is when accounts disappear, not gradually, but suddenly. The market doesn't care that leverage was offered easily. It doesn't care that the platform made it simple. It doesn't care that everyone else was using it too. Leverage removes time from the equation, and time is the only thing most traders actually need. This is why the final outcome is so consistent. History filters people slowly. Psychology destabilizes them quietly.